Hello, I'm Rich Pawson. Let's talk about some business cycles in the Dow Jones Industrial Stock Index. In late 2011, there was a 3-year cycle bottom. Now, the 3-year cycle is just a name or label. It actually spans 3 to 4 years, and in fundamental data, it may even be 2 to 4 years. It may also relate to the famous kitchen cycle, which has to do with business inventory. The only reason I don't use the kitchen name for a label is that the 3-year cycle can be found in things throughout nature, crop, temperature, precipitation, a variety of things, not just markets. Okay, another 3-year cycle bottom came in early 2014. Now, there was very little downside, very unusual. I think with everything that's been going on since 2009 with the QE, that we can go ahead and buy into why there wasn't much downside. It's also a sign of a running correction, something quite bullish, and the market did go considerably higher for a considerable amount additional time. Now, in August of last year was the first opportunity for the 3-year cycle bottom. We've seen a significant rally and a significant pullback here for early January, which has been quoted as the worst ever performance in the first 3 weeks of January. Although this low has not violated this low, I'm assuming this very well could be the true 3-year cycle bottom, a second chance. I'm also looking for a level 1 cycle low now to early February. And I also see Asian markets also setting up for something going into early February. So I think there's going to be a bounce into about April, maybe May, maybe to late March for an L1 cycle top. But coming out of this 3-year cycle, the stock market should rally on into 2017 is the best guess right now for that top. It could even delay into 2018, but we'll go with 2017. Now notice it also respected this trend line here recently. Notice we have some level 1 cycle lows coming in. And it's just time for another bounce and a recovery in the stock market. Now the 9-year cycle is actually up from 2009 and can remain up all the way into 2019. Then we'll probably get a recession, a bear market of like 20 or 30%. No crash and burn. And the reason for that is super cycles are up from 2009 and the 1930s, and they will now remain up into the 2030s. So the 9-year cycle that relates to a recession about once a decade is not going to create 50% to 90% crash and burn type recessions and bear markets. Now this is a chart of a PMI Manufacturing Index. It's the ISM version, which I'm getting a little leery of using it. It seems a little emotional and volatile compared to the markets version. At any rate, 9-year cycle low all the way up to 72-year cycle lows for the economy, 2008, 2009, depending on what indicators you're looking at. 3-year cycles for this particular indicator. And yes, it's taken longer than anticipated. The model simply pushed it out and still seeking a bottom here for manufacturing. And it's still forecasting an improvement into 2017. Now, people are getting nervous that the indicator has dropped below 50, which is a sign of a contracting economy. If it drops down to 45, it's going to be a recession. But I'm not convinced it's a true decadal or 9-year cycle related recession. I think we're probably going to get some recovery out of that. Now, the consumer confidence indicator is showing that consumers are quite positive. This is the highest level in some time. It goes back even before the recession and the crisis and all that. And the bottom line here is consumers are much better mood than Wall Streeters and core businesses. I think there's a little bit of a psychological problem on Wall Street and in business, not so much at the consumer. And the consumer has learned to not jump out of the stock market for every little sporadic, volatile collapse, that they're better off sticking to their long-term investment plan. The market seems to recover. I think consumer confidence is coming out of a 3-year cycle bottom, but it's now so high that I'm not convinced these cycles have much upside. I think we can probably see a range sideways in consumer confidence, but I'm not forecasting a major slide in confidence, even though some people are getting nervous. The volatile markets will eventually weigh on consumers. I think the consumer is telling us a better economic story. The U.S. economy is hanging in there. I'm Rich Pawson. Thank you.